In addition to the concerns about outliving your retirement savings, inflation, the demise of guaranteed pension plans, and market volatility, leading Canadian financial expert Moshe Milevsky recently identified another critical factor that can affect a retirement portfolio. It's called the retirement risk zone.
The retirement risk zone is a term that we use to describe a period in your life around retirement where losses in the stock market will have a disproportionate impact on the amount of time your income will last in retirement. If markets decline somewhere around 5 to 10 years before or after your retirement, there's a much greater chance that you will have to reduce your standard of living at some point in retirement. That zone, that period of time around retirement, is called the retirement risk zone.
Let's examine why you're at greater risk from stock market declines near or at retirement compared to when you're saving for retirement. When you're in the saving or accumulation phase, the order or sequence of your investment returns is less important, provided you stay invested and ride out the rough patches. For example, if you received a return of 7% one year, a negative 13% the next year, then a 27% gain the year after, you earn an average 7% return on your investment. In fact, if the sequence of these returns changes and the 13% loss comes first, your outcome would still be the same, an average return of 7%. However, if you're in the retirement risk zone, experiencing poor market returns early in retirement can significantly reduce your retirement savings and have an impact on whether they will last throughout your retirement. The reason is that your portfolio may not have the time to recover, the way it could for a younger investor, even if the market does rebound. Another reason is that in retirement, you're withdrawing money from your nest egg as income. Withdrawing money from investments that are already suffering losses from the markets may mean that you're depleting your declining investment much more quickly and could run out of money much sooner than you expected. Let's explore this further using the numbers from our previous example. Say you retired at age 65 with $100,000 and plan to withdraw 9% of your savings each year as income. Now, assume you were somehow able to receive a consistent 7% return every year on your investment. Your money could last for 21 years, or until you were 86 years old. Now, let's look at this again, but this time you earn 27% the first year, 7% the second year, negative 13% the third year, and so on in this order throughout retirement. Your average return is still 7%. But this time, due to a couple of good years in a row, your money actually lasts an additional 9 years, until age 95. But what happens if the negative return takes place right at the beginning of retirement? If we change the sequence of returns again so that you receive negative 13%, then positive 7%, and 27% in this order throughout retirement, the average return is still 7%, but now your portfolio is depleted by age 81, 14 years earlier than if you had the good returns 2 years in a row. 14 years earlier, all because you may have had the misfortune of suffering market losses in the wrong order. Isn't retirement the time to stop worrying about your investments and the market ups and downs? That's why Manulife Investments created Income Plus.